Welcome back to Give Me Credit. I'm J.S. Waldo, author of Mortgage Lending Explained, and we are here today again with our credit guru, John Mackey. Hi, John.
How
He's
are
also
you?
a credit genius. I'm well. Welcome to summer.
Yeah, thank God. Thank
Yeah,
God. I love the warmth.
get out all of that snow. You can, just so you all know, you can find us both on Substack. John is at creditgeniussubstack.com and I am at jswaldo.substack.com. You can find us, you can find Give Me Credit, let me get the words out correctly, on both of our Substack pages and on many podcast forms. So wherever platforms you like to listen to your podcast, you can find us there. I do know you can find us easily on Apple Podcasts, Spotify, YouTube. There's a few others that I've seen us showing up on. Subscribe if you can. If you like what you're seeing, like, subscribe, ring the bell, you know, all that good stuff. And please do converse with us, send us comments, questions, whatever. You can find our emails right on each one. You can email us directly. You can just make comments. We reply to everything. So today we have a very special edition of Give Me Credit. You know, John, it's funny. Every December, people look back. You go back, you look at your inventory of what you accomplished, what you lost, what you learned, whatever. And today, John, you and we're going to do the same thing. I know it's not December, but this is our final episode of our first season of Give Me Credit. You believe that? Here we are.
No, I don't. It's beautiful.
It's over 45 episodes.
Yeah.
And we've asked a lot of questions. So some of those are, why do credit scores sometimes punish people? Who did everything right? Why do debt collectors sound more certain in their paperwork? Why do smart people make financial decisions they later regret? Why are millions of Americans expected to navigate complicated financial systems that they were never taught to understand? We've covered some pretty deep stuff here. They led us into conversations about credit reports and debt collection and mortgages and student loans and bankruptcy and the systems that quietly shape our financial lives. And one lesson kept appearing. Most financial problems are not caused by stupidity. They're caused by confusion.
Yeah.
Consumers are drowning in information and opinions, trying to separate fact from fiction. This is our lives now, while making decisions, though, that can affect them for years. So the internet may be the largest financial classroom in history, but it's also become one of the largest collections of bad financial advice ever assimilated.
You got that right.
So we're going to slow it down. There's going to be no sell pitches, no magic formulas, just a conversation about what we learned, the myths that refuse to die, the lessons that surfaced again and again in these last 45 episodes, because one conclusion remains. The financial system is complicated, but it's not impossible to understand. And when people understand the rules, fear loses its grip, right? Confusion begins to fade. Better decisions usually follow it. And this isn't simply a review of the year. It's an investigation of what the year taught us. So I'm going to invite you all, grab a cup of coffee, got your hot tea, I got mine, whatever drink you like to relax with. Join us as we look back on 45 episodes of Give Me Credit. John, are you ready?
Let's do this.
All righty. Well, again, after 45 episodes, what surprised you most about what consumers don't know?
JS, I think when we started this podcast, I expected to find gaps in people's knowledge. Mm-hmm. What I didn't expect was the size of those gaps. And I'm not saying that to criticize anybody, quite the opposite. What surprised me most is that most Americans are trying to make major financial decisions with almost no formal education in the subjects that affect their lives every single day. Think about it. A person graduates high school. Maybe they go to college. Maybe they don't. But eventually they expect to sign a lease, buy a car, get a credit card, finance an education, purchase a home, buy insurance, understand taxes, and save for retirement.
Their whole life.
Yet almost nobody teaches them any of the systems and how they actually work.
Yeah.
Instead, They learn through trial and error. And that's an expensive way to do it. One of the themes we've come back to repeatedly throughout these 45 episodes is that consumers often know the outcome, but not the process. They know they got denied. They just don't know why. They know their score dropped. They don't know why. They know a collector is calling. They don't know what rights they have. And they create a tremendous amount of anxiety.
Yeah, I think that's exactly right. One thing I've seen as an underwriter is that consumers believe they're being judged when they're actually being evaluated. And those are very different things. A borrower comes into the process thinking somebody's making a personal decision about them. And in reality, when it comes to lending, the lender is evaluating risk. The underwriter is evaluating documentation. The automated systems are evaluating data and only data, but nobody explains that distinction. And we have found that a lot. So consumers personalize everything.
Exactly. And that leads to one of the biggest misunderstandings we've discussed all year. Mm-hmm. People think the credit system is judging character, and it's not. It's judging risk. Now, sometimes those overlap, but often they don't. I've seen wonderful people with terrible credit. I've seen irresponsible people with excellent credit. The score doesn't know the difference. The score isn't measuring morality. Getting to heaven the score doesn't dictate that. It measures probability. And that's a difficult concept for people to accept, because we naturally want systems to understand our circumstances.
Yeah.
The machine doesn't understand circumstances. The machine, that big dumb machine, understands patterns.
Yeah, I love that quote. Jake Hippenstow right there, that big dumb machine.
Yeah.
And that becomes especially important when people encounter financial hardships. Because life happens. We've said that so many times. I've written that line so many times. Life happens. Divorce happens. Medical problems happen. Layoffs happen. Businesses fail. Yet consumers feel ashamed. We ran across that a lot. Consumers feel ashamed because they assume a financial setback means they've failed as people.
One of the most important lessons from this year is that financial events should never become personal identities. And often we do that. Mm-hmm. A bankruptcy is an event. A foreclosure is an event. Right. A collection account is an event. None of those things define us as a human being. And honestly, if listeners remember only one thing from the 45 episodes, I'd want it to be that. Because once you stop defining yourself by the problem, you can start solving the problem.
Yeah, I totally agree with that.
So JS,
yeah.
After everything we've discussed this year, what's the biggest lie consumers believe about credit scores?
Oh, that's a fun one for me because it was even a little eye-opening for me. Learned a lot this season. The biggest lie is that they have one. That's probably the source of more confusion than anything else we've discussed. Consumers think they have a score. Singular. One score. One number. One measurement. And that's simply not how the system works. The reality is consumers have multiple scores, different bureaus, different scoring models, different industries, different purposes, mortgage scores, auto scores, blah, blah, blah. It goes on. Vantage scores, FICO scores. You've heard all of these things come out of our mouths and our guests' mouths. And the fact is they can all be different.
You know what's fascinating? Most consumers don't discover that until they're applying for something important. Mm-hmm. Everything seems fine. Credit Karma, whom I absolutely adore, he says with tongue in cheek, says 740. Experian says something else. Then they apply for a mortgage. Mm-hmm. Suddenly the lender says, nah, you're at 660. And they think somebody's lying.
Right.
Nobody's lying. They're simply using different scoring measure systems. Mm-hmm. Imagine walking into a doctor's office. One machine measures blood pressure. Another measures cholesterol. A third measures heart rate. Then getting upset because the numbers aren't identical. They're measuring different things. And that's exactly what's happening with credit scores.
Yeah, and here's where consumers get in trouble. They focus entirely on the number, right, John? They don't understand what created that number.
Yeah, exactly. Because the score itself is actually the least interesting part of the conversation. The real question is, why is the score what it is? What accounts are reporting? What balances are reporting? What utilization exists? What inquiries exist? Why histories exist? Those are the questions that matter. The score is simply the system. The report is the cause.
Yeah, I agree. And we spent a lot of time this year, John, talking about debt collection. So, what surprised you the most?
Honestly, no, I'm going to lie to you. Honestly, how much power fear still has. Not lawsuits, not judgments, not garnishments, fear.
Yeah.
Fear remains the most effective collection tool ever invented. And here's why, what's fascinating. Most consumers aren't even reacting to what is actually happening. They're reacting to what they think might happen. The phone rings. Excuse me, I'm losing my voice. A collector says legal review. The consumer hears lawsuit. Collector says possible judgment. The consumer hears they're taking my house tomorrow. The collector says we need to resolve this matter. The consumer hears, oh, shoot, my life is over. What we've learned through these episodes is that there's often a tremendous gap between reality and perception, and fear lives in that gap.
Yeah, I think that's one of the biggest misconceptions consumers have. They assume the collector has all the power. It feels that way. There's intimidation factors going on there, and we've talked about that. In reality, many consumers have rights that they don't even know exist.
Exactly. And the tragedy is that many consumers surround those rights before they ever use them.
They surrender them.
I can't tell you how many people I've talked with over the years who paid a debt before asking a single question. And my wife is proof of that. But think about it. Imagine somebody knocking in your door and said, you owe me $5,000. Would you say, wait a minute, let me go get a check? Of course not. You're asked questions. Who are you? Why and where did this come from? Can you prove it? Yet that's exactly what happens every day in debt collection. The collector calls, the consumer panics, and suddenly documentation becomes secondary.
Yeah, that's one thing that kept coming up through so many of our episodes this year was the difference between owing a debt and proving a debt.
You know, that's huge because those are not the same thing.
Right.
A debt may absolutely exist, but that does not automatically mean the person calling owns it. Fraud exists, my friends. It does not automatically mean the balance is correct. It doesn't automatically mean the statute of limitations hasn't expired. It doesn't automatically mean the document exists. One of the greatest lessons from our collection episodes is that consumers should never confuse confidence with evidence. Some collectors sound incredibly confident. That doesn't make them right. Documentation makes them right.
Yeah, and on the flip side of that, documentation works both ways. Consumers need it too.
Absolutely. In fact, if I could summarize all of our debt collection episodes into one sentence, it would be this. The person with the best documentation usually wins. Never the loudest, never the angriest, never the one with the most curse words, not the most emotional person, the best documented person. And frankly, that's not just true in collections. It's true throughout the entire financial system.
Yeah, that is a fact. So through our first season, we've been lucky enough to have lots of really excellent guests. One of our very first guests we had was Jerry Weston, and we had him on podcast 20 and 21. Loved him. He was a wonderful guest. But John, why did we even want Jerry Weston on the podcast?
Um, because the belief that banks and credit unions don't want to work with borrowers. Jerry explained that many lenders would rather negotiate directly than spend time and money pursuing legal action. And don't forget that Jerry was loss mitigation. In other words, he was the first party debt collector for a large credit union. But they're different than a third party debt collector.
Yeah, that's totally true. So what surprised you most about our conversations with him?
How often consumers pay debt relief companies every month and assume their creditors are getting paid when sometimes no negotiations had how negotiations had ever begun.
Yeah, and one of the things was that we talked about was why can debt relief companies actually make things worse?
Because they often tell consumers to stop communicating with their lenders. That communication blackout can lead to lawsuits, judgments, and even garnishments that might have been avoided.
Yeah, and Jerry gave us some good examples of that. Did Jerry ever say that all debt relief companies are bad?
You know, he didn't.
Mm-mm.
He didn't. But he did remind us that they are a business. They charge significant fees and often use standardized approaches that may not fit an individual's situation.
Yeah, he gave some very valid, very specific points and experiences he had. Did Jerry teach us about relationships between borrowers and lenders, did you feel?
Yeah,
What did he teach?
relationships matter.
Mm-hmm.
And that's the beauty of credit unions too. But credit unions and banks frequently have programs available, loan modifications, payment extensions, hardship arrangements, but they can't offer help if nobody is talking.
Yeah. What was the broader lesson from his first episode with us?
Fear causes people to outsource their problems. Unfortunately, outsourcing responsibility, it does not eliminate the problem.
Mm-mm.
Sometimes it simply adds another layer between the borrower and the solution.
So if you could, John, and you could summarize Jerry's message in one sentence, what would it be?
When financial trouble arrives, pick up the phone.
Yeah.
An uncomfortable conversation with your lender is usually far less painful than a long period of silence.
Yeah, I got that same message from him. I think he delivered it really, really well. And he was on twice, like I said. We got really good feedback on his episodes. Why do you think his episodes mattered so much to our audience?
Because everyone eventually faces financial stress.
Mm-hmm.
Jerry reminded us that communication, honesty, and early action are often the most powerful forms of debt relief available.
Yeah.
Jerry West reminded us that financial recovery rarely begins with avoiding your creditors. More often it begins with the conversation.
Yeah, I left our conversations with Jerry feeling like sometimes the shortest path out of debt isn't finding a middleman. It's simply having the courage to make that call.
Right? Even though your heart's beating a mile a minute.
Call your creditor directly.
And it's the easiest one.
Yeah, he delivered that really, really well.
Yeah.
So, but we had another guest, again, one that came on a couple times, David Cox. He was on episodes, he's an attorney. David Cox, he came on episodes 34 and 44.
Right.
He
was so good, we spread him out.
We did. We really enjoyed him. One episode dealt with divorce and debt collection. That was a really good episode. And the other dealt with judgments. But looking back, what surprised you the most?
Honestly, it was how people confuse legal decisions with financial reality. Now, in both episodes, David kept coming back to the same idea. The legal system and the financial system don't always speak the same language.
Mm-hmm.
You know, in the divorce episode, people believe that if a judge assigns a debt to one spouse, that problem is solved. But David reminded us that the creditor never signed the divorce decree. The marriage may end, The court case may end,
Yeah.
but the original contract often doesn't. And that realization catches a tremendous number of people completely off guard.
Yeah, so thinking about that divorce discussion, I think listeners were stunned to hear that someone can obey the divorce decree and still end up with damaged credit. And he explained it really well. Can you summarize why does that happen?
Because family court divides responsibility. Credit contracts divide liability. Those are two different things.
Mm-hmm.
If two people sign a credit agreement, the lender may still have rights against both parties, even if the divorce decree says only one person is responsible for making the payments. You know, David explained that perfectly.
Yeah, he did.
The divorce decree may create rights between the spouses. It doesn't rewrite the original contract with the creditor. That's where many financial disasters begin.
Yeah, we talked about that in depth, you know, even coming from my standpoint as a mortgage underwriter. We talked about, you know, how it is looked at, but what the ramifications can be. He gave us some great information on that. But then in his next episode, we talked about debt collections and judgment. So we moved into that. And then I think many listeners were surprised by that conversation too.
Yeah, and that was one of our most recent episodes.
Yeah.
Most people think a judgment means that the creditor automatically gets paid. And David essentially said, not so fast.
Yeah.
A judgment is a legal determination that money is owed. Collection is an entirely different process. Finding assets can be difficult. Certain assets are protected.
Yep.
Wages may have limitations. Retirement accounts may have protections. Homestead exemptions may apply. Suddenly, what looks like an easy victory becomes a complicated business problem.
Yeah, I think that when he started talking about creditors negotiating after winning in court, I think that shocked people. Why would someone negotiate after obtaining a judgment?
Because economics still matter.
Mm-hmm.
David reminded us that collecting money costs money. Attorneys cost money. Investigations cost money. Enforcement costs money. Time costs money. A creditor may have a judgment worth thousands of dollars and still decide that settlement makes more economic sense than chasing assets for years. That was one of the biggest takeaways for me. Debt collection often becomes less about legal rights and more about practical business decisions.
Yeah, and I went back and as I listened to both interviews, I kept hearing the same message.
Yeah, exactly. Reality eventually gets a vote.
Mm-hmm.
In divorce, people think a court order changes the contract. A lot of times it doesn't. With judgments, people think a court order guarantees payment. Again, sometimes it doesn't.
Mm-hmm.
David kept reminding us that the legal system creates rights, opportunities, and leverage, but it does not magically eliminate financial realities.
Yeah, and you know, it's fun to talk about the guests we've had. When I think about David Cox personally, what stood out to you about David himself?
His practicality. He never treated debt collection like warfare.
Mm-hmm.
He never treated divorce like a scorecard. He approached everything as a problem to be solved. And you know, that was refreshing. Yeah. He reminded listeners that good outcomes usually happen when people stop reacting emotionally and start understanding how the systems actually work.
Yeah. So if you were to summarize David Cox's message in one sentence, what would it be? And I know that's hard because you have a hard time with one sentences. But what would it be?
Good dig. I think it would be this. A court can issue an order. A judge can enter a judgment. A divorce decree can assign responsibility. But none of those things automatically change contracts, create money, or eliminate reality. Understanding that difference can save consumers years of financial pain. So how was that for one sentence?
Well, that was definitely about 5.
Okay.
Right on key for who you are, John. It's what we love about you. Going back to David Cox reminded us that legal documents have power, but they also have limits.
And perhaps that's the lesson
Yeah.
from both episode 34 and 44. Law matters. Documentation matters. Contracts matter. But ultimately, financial problems are rarely solved by assumptions. They're solved by understanding how the system actually works.
Yeah.
I want to bring up one of my favorite guests, and that's Jacob Hippensteel. And he talked about credit reporting. So let's talk about Jacob.
Yeah.
He was the Fair Credit Reporting Act attorney. He was from Arizona. Very bright and articulate man.
Yeah.
He was on podcasts 28, 35, and 37. Mm-hmm. We had some fascinating conversations with him this year. What stood out for you, JS?
Oh man, I love Jacob Hippensteel. Definitely one of my favorite guests. I think at first what stood out to me was not only how well he spoke, but the point he was making about the automation. That was probably the biggest eye-opener. Most consumers imagine that when they submit a dispute, somebody carefully reviews everything. They picture an investigator sitting at a desk reading documents. This is somebody's letter, evaluating evidence, looking for truth. This is what we all have in our mind when we do this dispute. Jacob showed us that the reality is often much more mechanical.
That was a huge moment for me too. Because consumers frequently tell me, I sent them 20 pages of documentation, and then they're shocked when the response comes back verified.
Yeah.
What Jacob helped explain is that many disputes move through highly automated systems, that big dumb machine.
Yeah.
The consumer is telling a story. The system is processing data. Those are very different activities.
100%. And it's funny because he used that phrase, the big dumb machine, that's exactly when I think about this system, the entire process of the automation of collection and debt and disputes and credit reports. That's what comes into my head, the big dumb machine. And that was eOscar. And that's where it became such an important discussion, I felt.
Yeah, exactly. Most consumers have never heard of eOscar, yet it plays a significant role and how disputes move through the system. When Jacob helped us understand is that modern credit reporting isn't built around individual investigations the way that we kind of imagine.
Right.
Built around volume. It's got to be built around volume because they're dealing with millions of records, millions of updates, millions of disputes. The challenge becomes, how do you process all that information efficiently? Unfortunately, efficiency and accuracy, they're not together. They're not the same thing.
Oh, and that's an important distinction. Jacob made that well.
Yeah, and frankly, it's one of the most important lessons of the entire year. A system can be functioning exactly as designed and still produce outcomes that frustrate consumers. Jacob wasn't arguing that the system is evil. He was explaining how it works. Mm-hmm. And once you understand how it works, a lot of consumer experiences suddenly make sense. The consumer says, they didn't listen to me. The system says, we process the information. They're not the same thing.
No, and that kind of brings us back to the same thing, back to documentation.
Exactly. Everybody comes back to documentation. Consumers often believe passion wins disputes. It doesn't. Documentation wins disputes. Facts win disputes. Evidence wins disputes. And Jacob did a tremendous job helping listeners understand that reality.
Yeah, he really, really did. But let's change gears for a minute. Let's talk about one of the biggest struggles that consumers continue to have, student loans and financial recovery. Let's talk about student loans first. Why do they remain so confusing to this day?
Wow. Because the system itself is confusing. So let's start there. Most students think they're taking out one loan.
True.
They're not. They're taking and looking at the credit report and discovering 6 or 8 or 10 or 12 or 24, one for each semester, one for each disbursement. One servicer becomes another servicer. Repayment plans change. Forbearances occur, deferments occur, then reporting changes. And consumers are left wondering, what the hell am I just looking at?
Absolutely. The reporting alone confuses people.
Absolutely. But that's what really stuck with me this year wasn't the loans themselves. It was the emotional burden attached to them. Student loans are different from many other debts. People were told these loans would improve their lives. They were told education was the path forward. Then they graduate and discover they're carrying obligations that may follow them for decades. That creates a unique kind of frustration.
Yeah, absolutely. And after that topic, we moved on to bankruptcy discussions. Very, very timely, important discussion.
Yeah, which I think may have been one of the most important conversations we had all year. You know, most of these we're saying were one of the most, and they all were important.
Yeah.
This one, bankruptcy remains one of the most misunderstood words in the American finance. The moment people hear the word bankruptcy, they often think failure. But bankruptcy isn't a character judgment. It's a legal remedy. Congress created bankruptcy because economic hardship exists. Medical crises exist. Business failures exist. Divorces exist. Life exists.
Yep.
I think
that's a big one. You're right. Life happens. That just kept coming up, right?
Yeah.
I think that's part of what surprised me as we went through the season too. The amount of shame people carry as life exists.
You know, exactly. And that's why something we keep turning, that we keep turning to throughout the year. Customers often confuse the financial event with personal identity. Hang on a minute here.
Yeah, drink that water. Good for you.
My voice is going. A bankruptcy isn't who you are. A foreclosure isn't who you are.
Right.
A collection account isn't who you are. Those are events, life events, financial events. But somewhere along the way, people start believing these events define them, and they don't.
No, they absolutely don't. And we've seen that repeatedly as we start talking about recovery, which we did talk about quite a few times.
Yeah, absolutely. In fact, recovery may be the most overlooked topic in personal finance. People spend enormous amounts of time discussing failure, very little time discussing recovery. Yet I've seen consumers rebuild after bankruptcy. I've seen consumers rebuild after foreclosure. I've seen consumers rebuild after divorce. I've seen consumers rebuild after devastating medical debt. The common factor wasn't intelligence. It wasn't luck. It wasn't even income. It was persistence. The willingness to keep moving forward. The willingness to learn. The willingness to stop looking backward and start looking ahead. And honestly, if there's one thing I hope listeners take away about student loans, bankruptcy, and financial setbacks, it's this. Financial problems are chapters. They are not the entire book.
Yeah, well said. And it's such an emotional topic, but you're right. You hear so much about failure and all the bad stuff. Nobody is talking enough about the slow recovery process. And I'm glad we did, and we'll continue that.
JS, one of the guests who really made me think this year was Neil Tift. We had him on podcast 38 and 42. We've talked about credit reports. We've talked about debt collectors. We've talked about underwriting. But Neil took us somewhere different, as only Neil can do. What was your biggest takeaway?
You know, it's funny because Neil was definitely, I got a lot of feedback on Neil's episodes with us, and he was a hit. I think the reason is because Neil forced us to ask questions that most people never stop to consider. We, like you said, we spend a lot of time asking whether something is legal. We talked about a lot of different topics, and is it legal? We kept asking Neil if something was ethical. And the thing is those aren't the same two questions.
That's what I was driving at, and exactly. One of the things that struck me was how often modern business confuses capability with wisdom. Just because we can collect data doesn't mean we should collect every piece of data. Just because we can predict behavior doesn't mean we fully understand behavior.
Mm-hmm.
Just because an algorithm can make a decision doesn't mean that decision is fair. And that's where Neil really challenged me. For decades, we've been told that technology is objective, that computers remove bias, that algorithms are neutral. But Neil kept reminding us that every single algorithm reflects human choices. Humans decide what data gets collected. Humans decide what variables matter. Humans decide what outcomes get rewarded. Humans built the machine.
Yeah, and once you understand that, you stop treating algorithms like magic. You start seeing them as tools.
Exactly. One of the examples that kept coming back to me involved credit scoring. The system may identify someone as high risk. The system may even be statistically correct. But what if the reason they're high risk is because they got cancer? What if it's because they lost their job during an economic downturn? What if it's because they cared for a sick family member? The machine doesn't know. The machine, that big dumb machine, only sees the late payment. And that's where the ethical discussion begins. Not whether the data is correct, but whether the conclusion is complete.
And I think Neil's larger point was that prediction isn't the same as understanding.
In fact, I had to summarize Neil's contribution, if I did, to the podcast in one sentence, it would be this. Number one, it won't be one sentence. Number two, the fact the machine can predict your behavior. The machine can't understand your life. And as our society becomes increasingly dependent on automation, that's a conversation we're going to keep on having.
Yeah, we have to.
Yeah. And JS, after decades in underwriting, we're going to flip to that. And I didn't even push in the clutch when I changed gears on that. So let's push in the clutch and change gears. And after decades in underwriting, what's the biggest misunderstanding consumers have about what underwriters actually do?
Oh, I think the biggest thing, and it's not just consumers, I think a lot of times even the people in the industry itself who work in the industry can come in with this attitude, and that's that underwriters are looking for reasons to deny loans. I hear that all the time, and it's not true. Consumers imagine underwriters sitting in a dark room, drinking coffee, and looking for ways to ruin somebody's day. That is so wrong. Nothing could be further from reality. There is not one underwriter I've ever worked with, ever met, that's trying to deny a loan. The underwriter is trying to understand the loan.
That's a powerful distinction.
Yeah, I mean, think about it. The lender wants the loan, right? The lender's the one who's paying you too. The loan officer wants the loan. The real estate agent wants the loan. The buyer wants the loan. Everybody wants the loan. The underwriter's job, who also wants the loan, is simply to determine whether the documentation supports the decision. That's it.
Yeah. One thing that surprised me during our discussions this year was how many loans fail because of documentation rather than credit.
Yeah.
Consumers think everything revolves around the scores, but often the problem is somewhere else.
Absolutely. We've even, I've written about it. We've talked about it. Underwriters can do loans even with people who don't have credit scores. I have literally seen borrowers with excellent credit get their loans delayed or even declined because of missing documentation.
Sure.
I've seen borrowers with mediocre credit get approved just like that because their documentation was excellent. Consumers underestimate how important the story behind the number really is. And when I say story, I don't mean emotion. I don't need that. I mean documentation. Can you prove your income? Can you verify your assets? Can you explain this large deposit that popped out of nowhere? Can you document your employment history? Those are questions that matter.
And I think one of the great lessons from our underwriting episodes is that lenders don't lend money based on confidence. They lend money based on evidence.
Exactly. And as an underwriter, honestly, that's true throughout the entire financial world, whether it's debt collection, credit reporting, underwriting, bankruptcy appraisals, evidence wins. And so that's why we crossed over so easily, John, you and I.
Yeah. It's funny. People often tell me the financial system feels unfair. And to be quite honest, sometimes it is.
Mhm.
But often what they're experiencing isn't unfairness. It's unfamiliarity. They don't understand the rules being applied. And that's why education matters so much.
100%. And John, one theme that kept surfacing throughout the year was shame. Why do people let financial setbacks define who they are?
Because money is emotional, much more emotional than most people realize. People think they're worried about debt. They're not. They're worried about what the debt means. People think they're worried about a bankruptcy, and they're not. They're worried about what they believe bankruptcy says about them. That's a very different problem.
Yeah, it is. And unfortunately, society reinforces it.
Exactly. We've created a culture where financial success gets treated as virtue and financial difficulty gets treated as failure.
Mm-hmm.
But life isn't that simple. One of the things we've seen repeatedly throughout these 45 episodes is that financial hardship often arrives through circumstances people never anticipated.
Mm-hmm.
Medical crises, divorce, layoffs, business failures, family emergencies, economic downturns. These things happen, and they happen to good people.
Yeah, life happens. One thing underwriting taught me is that credit reports rarely tell the whole story.
That's such an important point. A credit report may show a foreclosure. It doesn't show the cancer diagnosis.
Mm-hmm.
A credit report may show a collection account. It doesn't show the layoff. A credit report may show a bankruptcy. It doesn't show the business that failed during a recession. It doesn't show the outcome.
Mm-hmm.
It doesn't show the journey.
And I think that's why I appreciated our episodes that covered the human side of credit. And one in particular, we had a guest on M, and it was an emotional, real, raw conversation. And it reminded both of us, it reminded everybody, I think, that we're talking about people, not just numbers.
You hit it right on the head here. And frankly, if I could leave listeners with one message from the 45 episodes, it might be this. You're not your credit score.
Mm-mm.
You are not your bankruptcy. You are not your collection account. You're not your foreclosure. Those things may be part of your story, but they're not the entire story. Financial setbacks are chapters. They are not the book. And one of the most encouraging things we've seen this year is how many people have rebuilt after experiences they once thought would define them forever. Recovery happens. Reinvention happens. The future does not have to resemble the past.
Absolutely.
And I'm going to push in the clutch again here, JS.
Okay. All right.
So that one of the greatest things we had on here, as if Michael Brennan can be described as a thing. One of the things I enjoyed this year was our conversation with Mike Brennan, the founder and developer of Real Estate Education, for licensing as a realtor and continuing education. Now, he was on podcasts 40 and 41. What struck you the most about that discussion?
Yeah, I like that discussion a lot too. I think what struck me most was how much consumers misunderstand real estate professionals. I mean, I obviously ran into that a lot as an underwriter and being there through the whole transaction. Most people think a real estate license means expertise. Mike reminded us that a license simply means you've met the minimum requirements to begin. The real education starts after the license.
That was one of my biggest takeaways too. Consumers often see a successful real estate agent and assume they got there because they passed the test.
Mhm.
The reality is that they're successful because they learned the business. They learned contracts, negotiation, market analysis, financing, communication, problem solving, and most importantly, they learned how to help people navigate emotionally charged situations.
Yeah, I wrote an entire article about this as well. Real estate is not a DIY project. Buying a house isn't like buying a television. People bring emotion into this process. It's fear, it's excitement, it's anxiety, expectations, and sometimes, honestly, unrealistic expectations, John.
You know, exactly. One of the things Mike highlighted was that real estate professionals spend much of their time managing expectations. Consumers don't see that part. They see the open house, they see the closing. They don't see the dozens of conversations behind the scenes trying to keep a transaction together. And
Yeah, let's be honest about that. Many deals don't fall apart because of financing. They fall apart because of people.
yep. Which brings us back to one of the themes of the entire podcast. The technical side of a transaction is often easier than the human side. People are emotional.
Mhm.
Markets aren't. Math isn't. Contracts aren't. That's where good professionals earn their value.
Yeah, that actually leads me to a next topic, which was episode 43. Let's talk about that podcast, the one about appraisals. Everybody wants the deal to close, except the math. Why do you think that one was so important?
Because it is rarely talked about in the scheme of a real estate transaction. You know, think about it. The buyer wants the house. The
Mhm.
seller wants the sale. The agent wants the closing. The lender wants the loan. Everybody is emotionally invested. Then the appraisal arrives, and the appraisal doesn't care.
No, and I think that's what makes appraisal so interesting. I've always been deep into that. They're the financial equivalent of a referee. That's how I look at it.
Yep.
Nobody invites the referee to the party. No. But eventually, the referee gets a vote.
They sure do. And that's true throughout finance. Credit reports don't care about intentions.
Mm-mm.
Debt collectors don't care about explanations. Underwriters don't care about enthusiasm. Appraisers don't care about feelings. The system cares about evidence.
Yeah, math's math. One thing we've learned repeatedly is that consumers often confuse desire with value.
You know, that is so true. A buyer may desperately want a house. That doesn't increase the value.
Mm-mm.
A seller may need a certain number. That doesn't increase the value. The market determines the value. The data determines value. The math determines value. And that's what this episode was all about.
Mm-hmm.
Reality eventually gets a vote.
It's probably one of the best summaries of the entire year. And it was one line. Reality eventually gets the vote.
Yep.
So let's go and summarize a little further. John, after 45 episodes, let's finish with this. Why do we do this? Why does Give Me Credit exist?
Because every week we meet people who are confused. You know, they're not stupid. They're not unintelligent. They're not irresponsible. They're confused. And we live in a state of confusion.
Mm-hmm.
They try to navigate systems everybody ever taught them to understand. A young couple buying their first house, that can be scary, exciting, but scary too.
Mm-hmm.
A retiree dealing with a collection account, a student trying to understand loans, a family recovering from bankruptcy, a borrower wondering why they were denied. These aren't bad people. They're trying to make sense of a complicated system.
Yeah, and most of the time they're asking the same questions. That's what it comes down to. What happened?
Exactly. And our goal has always been simple. Explain what happened. Explain why it happened. Explain what can be done next. Not selling magic, not selling shortcuts or dreams. Just explain the rules. Because once people understand the rules, you can start playing the game and something interesting happens. The fear starts to disappear because you understand. The confusion starts to disappear because you understand. And people and better decisions start showing up because you understand.
Exactly. And better decisions create better outcomes.
Exactly. If there's one message from the first 45, it's this.
You've said that 5 times now, so we have 5 messages so far.
Okay. Financial literacy isn't about becoming rich. It's about becoming informed.
Mm-hmm.
Because informed consumers make better decisions. But better decisions create better opportunities, and better opportunities change lives. That's why we started. That's why we're still here, and we don't go away. And that's why we keep on showing up.
Absolutely agree with you completely. Now, after 45 episodes, though, let's be honest, John, is there anything we got wrong?
Nothing. Nothing.
Anything that surprised us? Anything we've changed our minds about?
Oh, no. I've told you before, I'm perfect. I thought I was wrong once when I was right. Anyway, that's a great question because people often assume that experience means certainty. The reality is that experience should create humility. That brings home with what I just said, because that shows me I'm not human. I don't have any humility. One thing I've changed is the thinking I have about consumers themselves. When we started this podcast, I think I believed the biggest problem was lack of knowledge. I thought consumers simply didn't understand credit, debt collection, mortgages, and financial systems. After 45 episodes, I don't think that's entirely true anymore. I think the bigger problem is consumers are drowning in information.
Mm-hmm.
20 years ago, information was scarce. Today, information is everywhere. TikTok, I love those guys, sarcastically, it has an opinion. YouTube has an opinion. Facebook has an opinion. Credit Karma, lovely people they are, has an opinion. Your brother-in-law has an opinion. The guy at the bar has an opinion. The challenge today isn't finding information. The challenge is identifying which information is accurate.
Yeah, I think that's exactly right, John. And I think that we do this both on this podcast, but we both also do this in our writing. Consumers aren't uninformed. They're overwhelmed. That's a great way to put it. And when people become overwhelmed, it's human nature, they fall back on shortcuts. They want simple answers. They want these answers, they're simple answers to a complicated question. And the financial world just doesn't work that way.
Exactly. How many times have I said that today? Exactly. And one thing this podcast has reinforced for me is that complexity isn't the enemy. Confusion is the enemy. Yeah. Our job isn't to oversimplify. Our job is to explain.
Yeah, and I think that's always been our goal. That was our goal of how we align. But, 45 episodes, so.
Yeah. So let's go into something kind of fun here. What was the dumbest financial advice we heard this year?
Oh, we actually we heard some really stupid advice this year. I think the dumbest was just pay it.
Exactly. I can't tell you how many times we've heard that. A collection of years. A friend says, just pay it. A relative says, just pay it. An internet expert says, just pay it. Nobody asks the important questions. Pay what? To whom? Why? Under what circumstances? Can it be validated? Can ownership be proven? Will paying it help? Will paying it hurt?
Yeah, that's one thing our collection episodes repeatedly demonstrated. And we had quite a few of those because that's such a big thing. I mean, people are hurting out there. Financial advice without context can be dangerous.
Yep. The financial world is full of one-size-fits-all advice. Mm-hmm. The problem is that consumers don't live one-size-fits-all lives, which helps one person and may hurt another.
Yeah.
That's why we've always encouraged listeners to ask questions before taking action.
You're absolutely right. But let's look ahead now. As we're looking ahead, what concerns you most about our future?
The growing gap between consumers and the systems evaluating them. The systems are becoming smarter. Consumers aren't necessarily becoming more informed. thinking about what we discussed with Neil Tift, algorithms know where you've been, what you've purchased, how you spend your money, and how often you borrow, how frequently you balances increase. The machine is collecting extraordinary amounts of information, yet consumers often have less understanding of the process than ever before.
Yeah, it's almost as if the system understands consumers better than the consumers understand the system.
Yeah, you're absolutely right. And that's what worries me. Power tends to accumulate wherever information accumulates.
Mhm.
The more the system knows about consumers, the more important consumer education becomes.
Okay, well, let's.
What? Let's get into another question.
Okay.
What gives you hope?
Mm. I think what gives me hope and was giving me hope for a long time, especially in my underwriting career, is recovery. I see it constantly. I've seen consumers rebuild after bankruptcies, after foreclosures. I've seen scores increase dramatically. I've seen families buy homes after years of financial hardship.
You know, that's one of the most encouraging lessons from the entire year. Consumers often think setbacks are permanent, and it rarely is. The people who recover aren't always the smartest.
Mm.
They're usually the most persistent, though. They learn, they adapt, they stay engaged, and eventually they move forward.
Yeah, absolutely. So thinking about that, John, what consumer story stayed with you?
You know, it's one that I think we've forgotten about in many cases. Happened early on in our podcast, and that was the Rochester nurse. And that story sticks with me. Here's someone whose housing options were being limited by a relatively small difference in credit score. Not because she was irresponsible, she wasn't. Not because she wasn't working, she was working, but because the system had thresholds. And that one thing we've tried to teach throughout these episodes. Sometimes the difference between approval and denial isn't huge.
Mm-mm.
Sometimes it's a handful of points, a single collection account. Maybe it's a utilization issue,
Mhm.
a reporting error, and that's why details matter.
Yeah, and I think that that comes exactly back to what we've been talking about. That's why education matters. Most consumers don't realize how close they often are to achieving their goals.
Okay, let's put each other on the spot here.
Okay.
Which guest had the biggest impact on your thinking?
Oh, for me, that's easy. One of my favorite guests was Jacob Hippenstall. And it's because he showed me how much of the credit reporting system consumers never see. I learned so much. Most people think disputes are investigated. Jacob helped explain in a very understandable way how disputes are processed. That distinction changed the conversation about the big dumb machine.
You know, I can agree with that. I love Jacob.
Mhm.
He's going to be on our show next year, too.
Yeah.
But another would be Neil Tift. For
Yeah.
me, he challenged us to think beyond compliance. Most of the financial world asks, is it legal? Neil kept on asking, is it right?
Yeah.
Those are very, very different questions.
And I got very good feedback on that too, because I think it resonated with people. You know, they have these same thoughts. But thinking about that, what questions should consumers be asking that they're rarely asked?
You know, this may be my favorite question. Consumers ask, what's my score? They rarely ask, why is my score that number?
Mm-hmm.
Consumers ask, can I get approved? They rarely ask, what determines approval? Take control of that.
Mm-hmm.
Consumers ask, how do I remove a collection? They rarely ask, can the collection be validated? They may ask, why was I denied? They rarely ask, what could I change to improve the outcome? The quality of answers depends upon the quality of the question.
Yeah, and like you said earlier, we both said consumers are drowning in information. So if you could teach one class to every high school senior in America, what would it be in?
Well, my lane credit reports, credit scoring, interest, debt, mortgages, insurance, taxes, contracts, student loans,
Mhm.
consumer rights, and perhaps most importantly, how to recognize when someone is trying to sell you something using fear. Because once people understand incentives, they begin seeing the world differently.
Yeah, we talked about that in lots of different ways over these 45 episodes. John, if someone listened to all 45 episodes and remembered only one sentence, I know you can't do it, but we're going to ask the question. What would it be?
Uh, the financial system is complicated, but it's not impossible to understand. Number two, most consumers think the game is rigged because they don't know the rules. The moment you learn the rules, everything changes. You stop reacting, you start planning, you stop feeling helpless, you start asking better questions. You stop being a spectator. You become a participant. And after 45 episodes, that really is what Give Me Credit has always been around, has always been about. Not teaching people how to beat the system, teaching people how to understand it.
Yeah, I agree with you completely. And that's, I think, what sets us apart, John, is that we're not here trying to tell everybody this is how you fix everything. We're trying to share information and give education about real life things that affect us.
Yeah.
Well, we've had
Yeah.
our first, this has been our first season, 45 episodes. And I'm happy to let everyone know that we were signed on for a second. So we will be going on a hiatus. I want to just let everybody know this. We were going to go on a summer hiatus. We're not going to disappear. John and I, and we've gotten together and found our best, most, I would say, popular ones that we're going to rerun for the summer. Again, we're going to still ask you to please follow along. As I've told you before, I'm J.S. Waldo, author of Mortgage Lending Explained. Our credit guru is John Mackey, author of Credit Genius. You can find us on Substack, creditgenius.substack.com or jswaldo.substack.com. But again, this is a podcast. You can find us on all the platforms. I'm going to ask you to, if you haven't, go back, listen to some more episodes, ring the bell, like us, subscribe. We will be back. We will be returning with all new material starting on September 8th, right after the little...
You are correct. You are correct.
In the meantime, we're still here. We're still working. So comment, ask questions, send us ideas. Let us know what you want us to talk about. We're planning our content for the next season, and we want to invite you to be a part of that. So, John, 45 episodes. It's been amazing.
It has. You know, when we started on this journey, I didn't know where it was going to take us.
Me either.
And that's part of the beauty to it, is part of the fun. Because the joy is not when you arrive at your destination, it's the journey.
Yeah.
And I've learned a lot from you.
Same.
And it's been a fun ride. I enjoy talking to you about these topics. You've got a vast array of experiences, as do I, with different areas, but similar. Different but similar. And I thoroughly enjoyed this time.
Me too. And I look forward to our next season. But I'm going to end this the same way we started, John, because we started with one of the most fundamental basic things. Everybody needs to know what's on their credit report. Everybody needs to know what data has been collected. And there is a way to do this that is free. You don't have to go pay for this. You don't have to join these Experian, Equifax, and all these little things where you pay monthly. You can get a free credit report. Tell them where they can do that, John.
At annualcreditreport.com.
Yes.
This is where we started. This is where we're going to end these podcasts. We just recently had another client that had not pulled her credit report, her annual credit report. Had she done it, she could have avoided a lawsuit.
Yes.
And it's a process we're going through right now. So anyway.
But not blame. Again, there's fear involved. So we want to invite you to jump over that little hill and get this in front of your face so that you can start just being aware. Take this information that we're giving you and utilize it in your everyday lives.
Yeah. Yeah.
Well, John,
let's get off on our summer break. I'm going to kick off my